Hello traders, and welcome to another live webinar regarding the psychology of trading or trading psychology. Today the topic of our meeting is psychology of stop loss. Before we start, I need to present to you this disclaimer. Of course, this is the disclaimer regarding the risk involved with trading with various commodities, stocks, cryptocurrencies, or currencies on various markets. So that's the standard kind of a disclaimer I always present. So please remember our first rule of trading, which is very, very often as it is here in this quote: the first loss is the best loss. Basically, if you can cover your loss, the first one is usually the best loss. So we will be talking about psychology of stop loss. I hope that you know what a stop loss order is. It's a protective order that you send to the stock exchange or your broker that informs your stock exchange or broker that you want to quit your trade. It doesn't matter if you are long or if you are short, at a certain price, right? So this is how much you can accept, how much risk you can accept per one, of course, trade. But very, very often it is hard for new traders, for old traders, for professional traders as well. It's very, very hard to stick on the plan of cutting your losses very, very rapidly and letting your profits run, as they say in the US, right? Why it is so hard? This is our main topic for today. So we're gonna learn what is disposition effect. It's a kind of a cognitive psychology theme. We will see what is loss aversion or break-even effect. It is very, very popular and very well researched topic from, of course, cognitive psychology. And we will just touch the prospect theory in trading, but it will be definitely related to the trading and the trading industry. And of course, at the end, I will show you how traders can overcome those biases. So this is our agenda for today. I hope you guys will like it. So let's just start with the first thing. Many new traders, many new people who are new to trading have a tendency to liquidate positions that show a small profit. Yet they keep those positions that show a loss and are unwilling to take this loss or to cover this loss in hope that prices will rebound. Such a counterintuitive strategy will result in small wins and large losses. But why do people still do it, right? It doesn't make any sense. Well, it doesn't make any sense, but it's very, very well connected to the other part of your psyche, which is the emotional side or motivational side of your psyche. The new science, which is called the behavioral finance psychology, may offer some kind of an explanation, and what they have found is something that is called the disposition effect. What does it mean? That means there are some investors that are less willing to recognize losses, which they would be forced to do if they sold asset which had fallen in value, of course, but are more willing to recognize gains. This can be explained by the value function curve, where the investors turn more risk-seeking as the stock depreciates, as the stocks goes down, right? As shown by studies on ex-post returns by traders, it would be more profitable to cut losses fast and let, of course, the profits run. Hence, the investors should treat unrealized losses as a sunk cost and focus on reducing prospective costs, likelihood of more losses, of course, but they don't do it. Unfortunately, the irrational hope destroys any edge their analysis provides, thus resulting in unfair gamble and not, of course, trading, right? So this is the disposition effect. Basically, that's the first thing, is that the first effect, the cognitive effect, that explains a little bit why it is so hard to cut your losses and to let your profits run. So you can, of course, adjust your stop loss levels efficiently. Now I'm going to tell you about some kind of a market research that was done by the company for very well-known broker from the US. I cannot say the name. So what they've done, they have researched 43 million transactions. Those transactions were analyzed in one of the largest forex brokers in the last quarter of 2014 and first quarter of 2015. What they have found out, they have analyzed all of the trades that were made in that period, and they have found that traders make more money most of the time. Fine, because over 50% of these transactions they've made are profitable, right? So traders are in money. They make money most of the time, and 50% of the transactions they do are profitable. So this is the result. This is of course, the forex market. So those are currency pairs. As you can see, the blue is the winning percentage. The reddish kind of a color is a losing percentage. So as you can see, the percent is very often above the 50. As you can see on the left side, we have a scale of the percent, and the blue boxes are really bigger than the red boxes, which means that on all across the currencies, right? The currency pairs, which means they really have the winning percentage on 50% of their trades. As you can see here, that's something different. This is the chart that shows you average gain and average loss on every trade. So let's see, for example, the euro to dollar. The euro dollar average gain is 40 pips. So in a stock market, it's 40 cents, let's say. And average loss is roughly 68 pips, which means 69 cents. So what does it mean? That means if traders were right more than 50% of the time and close the trades profitably, why are the most of them still losing the money, right? Because that's why this research was done. Why these people losing the money? If they are 50% of the time in profit, right, and they still have a winning position, why they are losing the money? Because as you can see, they lose more pips, more cents on losing transactions than gain pips on profitable transactions, right? So if there is a loss, the loss is big. If there is a gain, the gain is small. So why this is happening? Why people do this? You got it. Those results are made from made of an independent research company, right? So the question is why they do it. The old stock proverb says, of course, cut your losses fast, let your profits run. So why this is so difficult to follow? Why people have a problem to follow this simple proverb, this simple saying, cut your losses fast, let your profits run? What kind of a mechanical not, but a psychological mechanism is responsible for this sort of behavior? Even if you are 50% of your time in profit, if you're right, you are still losing money. Sooner or later, your profits are worse than your losses. Your losses are bigger. Why this is so difficult to follow this recommendation? So that's the second thing I would like to point out in this meeting: the loss aversion or break-even effect. Again, the roots of this effect, the loss aversion or break-even effect, is from the prospect theory. I will speak about it a little bit more later. And this refers to investors' tendency to strongly prefer avoiding losses to acquiring gains. For loss aversion, investors prefer an uncertain gamble to to a certain loss as long as the gamble has the possibility of no loss, even though the expected value of the uncertain loss is lower than the certain loss. For the break-even effect, investors prefer a gamble that offers the potential of recovering to finish aspiration level rather than a certain rate of return. So this is the loss aversion and break-even effect. Some studies from a field of the cognitive psychology suggest that losses are twice powerful psychologically as gains. That's very important information here. Hence, the investors will cling to the hope, including many of the different ways they try to rationalize their behavior, of course, and to the hope that prices will rebound to the entry price, at least to the entry price, which they have now established as a reference point. However, this reference point is illogical since their entry point doesn't affect the future direction of prices, right? It doesn't matter for market where is the entry point of your particular trade. One question in that moment is to ask yourself, if you don't have a position now, would you open a new position? If you want to get rid of this effect, or if you want to be more conscious of this effect on your trading. If prices fall past their stop losses, right, showing that their analysis was wrong, basically they are wrong, they are losing money, it means that the odds are now against them, of course, right? So if prices fall but do not hit their stop and subsequently risk back to, it rises back to break even, of course. It actually shows that their initial analysis is still correct because the stop loss has not been triggered. I mean, the analysis is not proven wrong yet, right? Because stop loss has not been triggered, which means that exiting, stopping the trade, quitting the trade at break-even is in fact destroying their winning trades, right? And this will lower their hit rate by causing them to exit winners prematurely, right? So this is the reason why they do it. And most people, most traders will avoid taking risk when looking for profits, and most people will actively look for risk if they can avoid loss, right? That's another fact from the psychological research. So again, there is a question, why most people avoid taking risk when looking for profits? Why most people will look for risk if they can avoid loss, if they can get rid of that current minus something on the balance or on the trading platform. So this is the prospect theory territory. Basically, this is a theory from David Kahneman and Amos Tversky, of course, the owners and the inventors of this theory from the field of cognitive psychology. So what do you have here on this graph? It's very important to understand this. You have a value and you have the outcome, right? So if you, on the right side of this graph, you see gains, right? You perceive gains, and your gains are being treated by your mind, by your psyche, the way that the $500 gain is, after a certain time, is always at the same value for your brain, right? You gain $500, oh fine, you are happy. Again, you made a profit of $500, you are happy again. Third time that day, you made a profit of $500, oh well, another good trade. Fourth time, fifth time, sixth time, your level of a value will be on the same level. Basically, your perceived level of this 500 value that you gained, that you earned from the market, is on the same level. But if you lose the same amount of money, let's say $500 again, your reference point will be continuously going down, which means that the same amount of money, $500, if you lose it for the first time, then for the second time, stop loss hit again, 500 gone, that's it. Every time you lose this $500, you will be perceiving this loss more painfully than gain of $500, if you know what I mean. So if you keep losing your money, first thing, you will clear your trading account, of course, but your psychological profile, your mindset will be way worse than it was at the beginning of trading, and it will keep going down as long as you will be losing money, despite the fact that this is the same $500 every single time. For the 10th time, for example, your reference point will go even deeper when you lose another $500. So this is the prospect theory. When you gain $500, that's fine. After 10 time, you will perceive it at the same level. When you lose $500 at the 10th time, you will be miserable. You will perceive everything as very, very in a depressive way, and you will be more frustrated, angry, and sad, because you will perceive this losses every time harder and harder. And it will be more psychologically painful for you. And of course, to recover from that state is very, very hard, right? Which is why you don't want to recover, because you know it's very, very hard. So you cling on hope, on some rationalizations that maybe your trade will go back to your level. Maybe someone will say something and trigger, maybe the news will trigger some kind of a move for the market. So you know that you are past your stop loss. You lost for 10th time in a row, for example, but you still have a hope. Your trading is based on hope that maybe something will change in the near future that will get you out of this trade, out of these losses, and maybe you will get to the break-even point. So at least you will be at zero, and well, maybe you will get your money back and profit. So that's how the prospect theory works, and this is the great example related exactly to the trading and to the stop losses, of course. Because that's why the stop losses are not being placed on the market at all in almost any trade. Because if you get 10 trades minus $500, that means, oh my god, I got so much money to recover, right? And this is unbearable for most traders, for the beginners for sure, to recover from this state. So this is why even they will gain $500, they will not perceive it as positively at the same level that they will lose the $500, right? So what to do to overcome these biases, what to do to overcome the disposition effect, and what to do to overcome the break-even effect, or for example the loss aversion, right? Because the loss aversion is one of the key factors here as well. So we have three basic biases that will rule your trading, unless you will get more out of every profitable move, right? And lose less on each lossy move, right? So if you have a profit, you have to profit big. If you have a loss, you have to lose small amount of money, right? So use the profit to the risk principle. So risk reward should be like 1-to-1 for each play. Minimum is 1-to-1. The way better is of course 2-to-1 or like 3-to-1 risk to reward, right? Some strategies can generate even higher risk reward ratio, like I said, 3-to-1, 4-to-1, or even more. The bigger risk to reward ratio, the better. The lower the likelihood of a given strategy, the higher risk to ratio should be set, right? So if no one expects that some stock, some cryptocurrency, some currency, God, whatever, will go, for example, up, then you should bet, then your risk to reward ratio should be bigger, right? Then in a situation when everyone sees, for example, head and shoulders pattern or whatever, something like this, right? The higher the risk to reward ratio or profit to reward ratio, the less often is necessary or possible to predict the market, right? Because the market will do the move anyway without you predicting it. The other thing is make the plan define before you trade. Take profit level, stop loss, and stick to it. Do not change it, do not move it. You will never know whether your last trade was because you were a good trader with certain risk reward ratio or because you were just lucky, right? Of course, if you have a good strategy, which means you're making money trading more often than you lose, of course, and you're making more than you lose, then you can only move stop loss to the break even or better when the market is going in your favor. So if it's going up when you're long or it's going down when you are short. Okay? Remember, traders should keep in mind that trading with an edge will increase the profitability over time, but it's not possible to be right on every trade. The number of times you win or lose doesn't matter. It is how much you lose when you are wrong and how much you win when you are right. That matters. You should also separate decision making from execution, meaning to plan the trade and to trade the plan. A good way to manage risk is to use a stop loss to limit one's downside, of course, and pick the trades only with a good risk to reward ratio. So this will allow you to cut the losses fast, and you will at least try to let your winners ride or run, or however they say. Please remember this three certain things that I would like to point out in this webinar. And at the end of my every presentation, there is a summary quote that is very, very familiar for everyone who is the beginner trader. One of the biggest hurdles you have to overcome as a trader is staying in the market long enough that you understand the market mechanisms and that your psyche, habitual and random reactions is no longer your enemy, because you are your own enemy in trading, basically. So please remember about this anyway. If there are any questions, please ask me now. All right, I think there is no question this time. Thank you very much for your time, and please stay with me for another presentation, because there will be two more presentations in English. Apparently, I think the one will be in March, and the other one will be in April 2021. If you would like to contact the partner of this presentation, the proprietary trading firm Global BD Trading, you have the means to contact here right now on this chat. From my side, that's everything. Thank you very much for watching, and I hope I see you guys on my next presentations. Thank you very much. Take care and bye bye.